You're looking at your offer letter from Google, and it's a whopping $500K total compensation package. The breakdown is as follows: a base salary of $200K, an annual bonus of $80K, and restricted stock units RSU worth $220K vesting over 4 years. At first glance, the math seems straightforward. You're expecting to take home around $375K, $400K annually, assuming a standard 20-25% withholding. However, this is where things get complicated, and most candidates, even those using popular salary aggregation sites, completely miss the real picture. In the years when your RSUs cliff, meaning multiple grant tranches vest simultaneously, you're not facing a 25% tax rate. Instead, you're facing a marginal tax rate of 48.52%, combining federal income tax 37% at the top bracket, state taxes up to 3% in California, and FICA taxes 35% for high earners. This means that in a heavy vesting year, your $500K offer might net you only $240K, $260K. The difference isn't just a rounding error. It's a substantial $120K, $160K annually. Over a 4-year vesting schedule, this translates to a cumulative take-home shortfall of $480K, $640K if you don't plan accordingly. To put this in concrete terms, that's equivalent to losing a year's worth of base salary money that could have been invested, saved for a down payment, or used for any number of financial goals. To put this into perspective, let's consider a detailed case study. Sarah, a software engineer at Google, received an L6 offer with the aforementioned compensation package in 2023. She was excited about the opportunity and initially negotiated for a higher RSU grant instead of base salary, thinking she'd maximize her earnings. Her vesting schedule was structured as follows: Year 1 cliff vest of 25%, $55K. Year 2 vest of 25%, $55K. Year 3 vest of 25%, $55K. And Year 4 vest of 25%, $55K. However, due to a promotion cycle and an equity refresh in Year 2, she received an additional RSU grant. This meant that in Year 2, she had both her original grant's second tranche and her new grant's first tranche vesting simultaneously, totaling $110K in RSU income that year. Sarah's tax situation looked like this. In Year 1, she earned approximately $360K in total income, $200K base plus $80K bonus plus $55K RSU plus investment income. This placed her in California's highest tax bracket, and after accounting for federal, state, FICA, and AMT considerations, her effective tax rate was about 42%, netting her around $209K. However, in Year 2, with $110K in additional RSU income from the vesting overlap, her total income reached $475K. Her marginal tax rate jumped to 51% on that incremental income, meaning the additional $55K in RSUs only netted her $27K, a shocking 50% haircut. Sarah wasn't expecting this, and it caught her completely off guard. She had to dip into her emergency fund to cover unexpected tax obligations because her employer withholding wasn't sufficient. So what exactly is the RSU tax cliff, and how does it work in detail? In simple terms, the RSU tax cliff occurs when the vesting of multiple RSU tranches in a single year pushes your income into significantly higher tax brackets. This is compounded by the fact that RSUs are subject to both ordinary income tax and the net investment income tax (NIT) for high earners, which adds an additional 8% tax on investment income above certain thresholds, $200K for single filers, $250K for married filing jointly. To illustrate this concept more concretely, let's look at a detailed example. Suppose you have 2 tranches of RSUs, each worth $100K vesting in the same year. You're a single filer in California earning $300K in base salary and bonus. If these tranches vested in separate years, each would be taxed at your marginal rate of approximately 45%, federal 37% plus state 3% plus NIT 8% slight deduction overlap, resulting in $45K in taxes per tranche, or $90K total across 2 years. However, if both tranches vest in the same year, pushing your total income to $500K, your marginal tax rate increases to 52%, federal 37% plus state 3% plus NIT 8% plus potential AMT considerations. Now you're paying $52K in taxes for each tranche, totaling $104K, a difference of $14K in that single year. This increase in taxes can have a substantial impact on your take-home pay, especially if you're not prepared for it. Over multiple vesting years with overlapping tranches, this difference compounds significantly. Now you might be wondering why popular salary sites like levels.fyi, Blind, or Glassdoor don't match reality. The reason is that these platforms use simplified tax models that don't account for the complexities of the modern tax code. While they can provide a rough estimate of your take-home pay, they're not accurate enough to capture the nuances of the RSU tax cliff, state-specific taxes, or the net investment income tax. According to a study by the National Association of Stock Plan Professionals, NASP, in 2023, the use of simplified tax models can result in a 10-20% error in estimated take-home pay, with errors reaching as high as 35% for high-income earners in high-tax states. This can have significant consequences, especially for individuals with complex tax situations who may be making life decisions, like relocating, purchasing a home, or changing jobs based on inaccurate projections. So how can you calculate your real take-home using 2024 IRS data? The first step is to determine your marginal tax rate by identifying your federal tax bracket based on your total expected income. For 2024, single filers in the $191, $950, $243, $725 range fall into the 35% federal bracket, while those above $243, $726 face the 37% rate. Next, add your state's income tax rate, or 50% if you're in a no-income tax state like Texas, Florida, or Nevada. Then check whether you'll be subject to the net investment income tax by seeing if your modified adjusted gross income exceeds $200K, single, or $250K, married filing jointly. This tax applies to the lesser of your net investment income, or the amount by which your MAGI exceeds the threshold. You'll also need to calculate the value of your RSUs and determine exactly when they'll vest. Most tech companies use a 4-year vesting schedule with a 1-year cliff, but some have different structures. Once you have this information, you can use a comprehensive tax calculator, such as TurboTax's tax calculator, or better yet, consult with a CPA or financial advisor who specializes in executive compensation. They can model out multiple scenarios, including tax loss harvesting opportunities, charitable giving strategies, or even negotiating for a gross-up provision in your offer letter that explicitly accounts for these tax liabilities. In addition to understanding the RSU tax cliff and calculating your real take-home pay, it's essential to consider potential counterarguments. One common argument is that the RSU tax cliff is a minor issue, and the benefits of working at Google, including health insurance, learning opportunities, and brand prestige, far outweigh the tax costs. While there's truth to this perspective, it overlooks the significant impact that the RSU tax cliff can have on an individual's financial situation and ability to achieve personal financial goals. Another argument is that individuals can simply plan around the RSU tax cliff by adjusting their tax withholding or investing in tax-advantaged accounts like 401(k)s or IRAs. While this is partially true, it's not always easy to navigate the complexities of the tax code. For example, 401(k) contributions are capped at $23,500 for 2024, which may not be enough to offset a 6-figure RSU vesting year. Additionally, not all income can be sheltered in traditional accounts, and the math becomes complicated when you factor in deductions, credits, and alternative minimum tax calculations. In terms of practical planning moves, there are several sophisticated strategies you can use to mitigate the impact of the RSU tax cliff. One approach is to accelerate income in low tax years and defer income in high tax years. For example, if you know year 2 will be a heavy vesting year, you might negotiate to take a smaller year 1 bonus and receive it deferred, or you might time significant charitable contributions to offset gains in high income years. Another approach is to invest in tax-advantaged accounts aggressively. Maxing out your 401(k) backdoor Roth IRA if eligible, and HSA if you have a high-deductible health plan can reduce your taxable income by $40,000, $50,000 annually. You can also consider working with a financial advisor to implement tax loss harvesting strategies, where you deliberately sell securities at a loss to offset capital gains, or investigate whether you qualify for business entity structuring if you have side income. A third strategy is to negotiate the terms of your RSU package upfront. Some candidates have successfully negotiated for RSU grants to be delivered over 5 or 6 years instead of 4, spreading out the vesting and reducing peak year tax hits. Others have negotiated for sign-on bonuses instead of additional RSUs, since sign-on bonuses are typically taxed as ordinary income, but are predictable and not subject to vesting cliff surprises. Additionally, some companies offer tax gross-up provisions or supplemental tax payments designed to offset RSU tax liabilities, though this is rare for RSUs and more common for option exercises. As expert financial advisor and tax specialist Tom Cooper notes, the RSU tax cliff is a significant issue that can have a substantial impact on an individual's financial situation. I've worked with hundreds of tech professionals, and the ones who suffer most are those who didn't plan ahead. It's essential to understand the tax implications of your compensation package and plan accordingly. By working with a financial advisor and developing a comprehensive tax strategy, you can minimize the impact of the RSU tax cliff and maximize your take-home pay. I typically recommend that candidates do this analysis before accepting an offer, not after. Additionally, data from the 2024 Silicon Valley Compensation Survey indicates that only 23% of tech professionals earning over $300K report having a dedicated tax strategist, yet 67% report being surprised by their tax bills in a given year, a clear indication of the gap between expected and actual tax obligations. In conclusion, the RSU tax cliff is a critical issue that individuals need to be aware of when evaluating their compensation packages. A $500K Google offer might realistically net you $380K in the best case scenario, and potentially as low as $240K, $260K in heavy vesting years. By understanding the tax implications of your RSUs and developing a comprehensive tax strategy, ideally before you sign the offer letter, you can minimize the impact of the RSU tax cliff and maximize your take-home pay. The key is to model out multiple scenarios, work with professionals who understand tech compensation